to individual investors, recommend stay long. No reason to get out yet. The market just made a new high a couple of days ago. You might hear people at Adam Taggart's show telling you to get out. There's going to be a crash ahead. But what we're telling our clients is there'll be a crash. The market's going to go down 50%. It first has to go down 7% or 8% before it gets down 50%. And
Sure.
clients following this program can sit through a 7 or 8% decline as long as they know there's a model that's going to get them out before it's down 50%. And that's exactly what they're trying to do.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today we've got the good fortune to speak with Milton Berg, founder and chief executive officer of MB Advisors, a premier global macro research and consulting company offering investment advice to the world's largest asset managers. Now, Milton's just made his proprietary buy-sell model available to retail investors for the first time, and he'll walk us through it today. Milton, thanks so much for joining us. Hey, it's a pleasure to see you, Milton. I think we've had you on once before, at least on the Thoughtful Money channel, but great to have you back on, especially early in 2026. Happy New Year. I hope you had a wonderful holiday with your family. We're off to an interesting start already here in 2026. So why don't we just get to the meat of it right out of the gate here? We'll go through your whatever charts you want to go through in a second, but at a high level, if you had to kind of pick a word or a theme to define what you expect 2026 to be like in the financial markets, what would it be?
Unusual.
Okay, unusual.
Unusual market, right? Not a regular market.
All right, and what are the main reasons why you picked that word?
Well, basically, you're seeing a culmination of years of speculation. Say gold and silver, platinum, palladium. Gold's up some 185% over the last few years. And the public is seemingly, and institutions as well, are saying, "Hey, there's inflation. Let's get on the bandwagon, get on gold now." But Weinberg shows me they were at the end of a long-term move rather than the beginning of a move. So with gold and silver probably going to reverse, with Bitcoin already in a bear market, with the stock market, according to some measures, as overvalued as it's ever been in history. Although we don't use overvaluation in our work, but the reality is an overvalued market is more likely to have some either hiccups or bear markets than a market that's fairly valued or undervalued. So markets worldwide and the debt situation. So I'd say it'd be unusual. I'm not saying the market is going to go down necessarily. When markets are in the current situation, usually you see more volatility than usual. You see more corrections than usual. And sometimes you see a major bear markets in that situation. Not what we're projecting, but I just say it'll be unusual and different.
Okay, so we had some great years in the markets for investors during COVID, right? Because just so much liquidity was getting shoved into the system. Folks then got surprised in 2022, but then we went right back to pretty quiescent markets that just like to go up. Sounds like you're saying 2026 is probably not likely to be nearly as quiescent. It might not be 2022 bad, but it's probably not going to be just the easy ride that we've had the past couple of years.
Well, it really depends on what takes place during the year. I mean, inflation is still high. There is chances of recession, so it's really difficult to predict at this time exactly what will happen. That's why I use the term unusual. I'd rather not make a projection, but once we're getting to the data, my data is saying, giving us many clear indication as to both what stocks and bonds could do, as well as what gold could do. So once we get to the data, it won't be just an opinion.
All right, well, far be it from me to stand between the viewers of this channel and the data. So why don't we get to your slides, Milton, and I'll just let you drive. You take us anywhere you like.
Well, first I want to start with, we have two types of clients. We have institutional clients who are somewhat more trading oriented. They're able to use leverage. They're able to go to sectors. They're able to go short one sector, long another sector. And now we just started a new project where we have retail, we call it individual investors. And individuals are more interested in the long term. So let me start with the institutional side a little bit. For the institutions, we're actually recommended to go short on December 11th, actually December 12th, December 11th at the close. On December 11th, we got a very rare sell short signal based on the VXN. VXN is the VIX, but it's a VIX using the NASDAQ 100 rather than the S&P 500. So we get I don't give away the secret sauce here, but basically we look at a short-term ratio to a longer-term short-term ratio to see some sort of a major shift in VXN relative to its short-term trading pattern. And this gave us sell December 11th. Now, through yesterday's close, the S&P has only gained 0.91%, 21 days past that signal. So everyone's so excited about the great 5-day, 6-day return we had earlier in the year. The reality was this short sale on December 11th is still very, very valid. Even though the market's up 0.91%, for example, in 2021, when we got the signal, on day 21, the market was up 0.94%, and the total decline from the date of the sell signal was 21.41%. So being up 0.91% is meaningless. We're short for our institutional clients, and if we're stopped out, we'll be stopped out. If we get 2.75% above the close of December 11th, this trade will not have worked. But at this time, despite all the hype and everyone talking about the first 5 days, tell you what's going to happen for the rest of the year, the models we look at tell us to be cautious, at least for institutional type investors who can trade, who are watching the screens every day and able to get in and out. So our official recommendation now is to be short the S&P 500 or whatever index you choose. That's as far as that goes. Now, I say we'll talk about the retail investors. For the retail investors, or we call them not really retail, but we call them individual investors, it's a totally different story. So what we have is this. We went long. We have a model we created. I spent 10 years working on this model. It's a model unlike anyone else in Wall Street has, which I hope to demonstrate in the next couple of minutes. But basically, this model we begin this model in 1957 for the S&P 500. The first question we're asked is, the S&P 500 began in 1928. Well, what kind of model starts in 1957? Well, the answer is in 1958 to 1957, there were only 90 stocks in the S&P 500. And the committee that was deciding what goes into stocks was very, very slow. So stocks weren't changed that often. In 1957, they raised it to 500 stocks. So now it's a very broad index that represents 80% of the total U.S. stock market. So we started in 1957 to create our models. The model since 1957, getting in and out, basically, we have an average of one round trip trade in 1.25 years. Again, it's for individual investors. A hedge fund couldn't get away with this. But basically, since 1957, the average trade, you buy S&P and you sell the S&P until you buy the S&P again, it was an average of 1.25 years per trade. And we have the models telling us that the gain per annum was 18.5%. This is total return, including dividends, relative to a buy and hold gain per annum of 10.9%. So it's a very, very amazing outperformance. Now, many institutions, almost all institutions would be happy to have a 68-year track record of 18.5%. I don't think there was any institution that has that track record. Even Warren Buffett has sunk below it. So it's an amazing return. So on individual investors, we recommended getting long on April 4th. Again, that was just a theoretical recommendation because we didn't start our individual investor program yet, but we started an actual account on June 1st, and that account is up nearly 18% since June 1st, being 100% invested in the S&P 500 through the VOO rather than the SPY, because the VOO has a less expense ratio than the SPY does. And we actually slightly outperformed the market through yesterday by 0.3%, which is fine. So to individual investors, recommend stay long. No reason to get out yet. The market just made a new high a couple of days ago. You might hear people at Adam Taggart's show telling you to get out. There's going to be a crash ahead. But what we're telling our clients is if there'll be a crash, the market's going to go down 50%. It first has to go down 7% or 8% before it gets down 50%.
Sure.
And clients following this program can sit through a 7 or 8% decline as long as they know there's a model that's going to get them out before it's down 50%. And that's exactly what they're trying to do. So this is the first thing I want to discuss. And
okay. Milton, can I ask you one question about this model that you're trading off of now?
Yeah.
Is it binary? Is it 100% in the S&P or 100%
market,
stuff?
we believe as long as America remains a capitalistic society, and I can't predict the future, you never know what's going to happen 10, 15 years down the road. But as long as America remains a capitalistic society, the stock market should continue. What it's done over the years is go higher and higher and higher. On an index basis, it's up 7.9% per annum over the last, say, 100 years. On a total return basis, it's up nearly 11% per annum. So that should continue happening. So we tell our investors the S&P 500 is the broadest index. You're not an institution. You don't have to try to pick which sector. You don't have to pick either technology or pick biotech or pick utilities. Get it. 80% of the stocks of the value of the stock market is in the S&P 500, and that's where you're going to be to take advantage of the major up moves. The problem is people don't want to sit through down moves, and that's why we have the model The model tells you when to get in. The model is very, very precise, which we'll see soon, in when getting in. It's not very precise in getting out. So what we did is I wasn't able to model market tops as well as modeling market bottoms. So we said to ourselves, either the market's down 7 or 8%, no matter what the fundamentals are, we're going to get out and wait for the next buy signal. Just to point out, going back to the previous chart, you see we show us 18.5% if you got out at 8%. You actually have a greater return if you got out when the market's down 7%. The
Huh.
problem is there's far too many trades. We're having 1.25 trade per annum. If you get out at down 8%, you have about more than one trade per annum if you get out at 7%. So basically, we really favor getting out when the market's down 7%, but we retain that flexibility. I'm not telling our clients that I promise you when the market's down 8%, 7%, you'll be out, because most likely we won't be out unless the market's down 8% or so. But that's not etched in stone. What is etched in stone is when we get in, and we try to get in. The models are built to get in really within days of a market low, and it's been very, very successful in doing that. So these are this is just one chart showing all the buy signal dates since 1957. And you can see April 4th, 2025 was the last buy signal. Prior to that was November 2nd, 2023. And we'll get to the next, give you a little bit of better idea what we're doing. This is what the model has done. I'll get to the insides of the model very soon. Now I just want to give you the background as to what the model has done for us and exactly what goes into the model, because I know everyone is going to be very skeptical when they see this data, because no one has ever created this type of a model in the stock market, especially not using leverage and just using a broad index.
Mhm.
So this is we call it the edge model, and Milton Berg edge is what Jennifer decided to call it.
Hmm.
And this is the yearly return relative to the S&P 500. So I highlighted the years in which the market went down just to give a contrast. So in 1962, with the S&P down 8.83%, the model was up 18.55%, basically because it was out during the bulk of the decline and got in within days of the low in 1962. In 1969, the market was down 8.4%, and the model was up 0.99%, again outperforming. 73, there's a 73, 74 two-year bear market. In 73, the S&P was down 14.8%, and the model was flat, down 0.2%. But in 74, with the market down another 26%, the model was up 20%. This is what basically should take place. In
Right.
bull markets, they'll do exactly what the market's doing. Let me give you an example. So in
That's
19,
amazing, though. I just got to
2014,
say.
2014, the model's up 13.5%, so is the S&P. 2013, the market's up 32%, and so is the model. So in an up market, you're not going to outperform the market. But when the market goes up, has either correction or a bear market goes down, and you're out for even a small part of that decline, and you get back in close to the low, you'll do well. Now, we all know investment advisors are taught to tell the clients, if you miss 5 of the greatest days in the market in any given year, you're going to way out underperform. So don't bother timing the market. That is very, very true. If you miss the great up days in the year, you'll do very, very poorly. But you'll certainly do very, very well if you miss the down days, the bulk of the down days. And as we know, in any bear market, the greatest volatility doesn't take place early in the bear market. The greatest volatility takes place at the end of the bear market. So if you're out at a 7 or 8% decline in a market that's going down 20%, you will be able to retain some of the great losses that index investors have. And if you're getting close to the lows, you probably gain nearly all of the gains you're going to get on those glorious rallies that take place off a major low. Anyway, this is something I wanted to show as well, which is just the year-over-year model and exactly what it has done for what it has done theoretically. Now, I
Well,
mentioned
you've
in the
sold
first,
me. Those are super impressive returns.
super impressive. I know, be skeptical. I want you to hard questions when we get under the hood. We're not under the hood yet. Just giving the background. Just
Yeah.
a sales pitch. Number of trades per year for the S&P 500, S&P T-bill. This is the model where you long the S&P 500, no leverage, and when you sell, you don't go short. You purchase T-bills or a money market fund. And I just highlighted the years there are no trades. See, 58, 61, 63, 67, 77, 72, 83, 81, 2024, 20, no trades. So this is perfect for a long-term investor who doesn't want to be calling his broker every day, doesn't be looking at CNBC to figure out when the next crash coming. He may not be so interested in listening to Adam Taggart any longer, because he'll know he has this kind of a program where you'll get out before bear market fully develops, and he'll get in at the lows. Now, I know this sounds very, very like I'm a charlatan or so, but we're going to now start getting into, in a couple of minutes, we'll get into under the hood and see exactly what's involved. As I say, I worked on this for 10 years. I think nobody else has a product even similar to this. And again, my institutional investors have seen a lot of this in the past, but even for them, I only finished the model in September of this year. So it's now sort of, it's totally complete, but they've seen a lot of my models. but now we've systematized it a little bit more. We have about 2,000 models. For the individual investor account, the models that we're showing were built using about 880 models, not all 2,000. And there's reasons for that. We'll get to that later on. This is the actual total return, showing the trade by trade total return. Control L. It'll make it a little bigger. Basically, the model has gained 18.5% since 1957. A $10,000 investment in an IRA or a tax-free endowment from 1957 to 2025 would have grown to $1,107,896. That's the
Oh my God.
miracle of compounding. The S&P, which has grown 10.9%, which is a great return, the 10,000 would have grown to 10,377,654. That's not a bad return either. But we're trying to do something that is not expected. We're trying to see returns double or triple, not return double or triple, but you want to see a balance after 30, 40, 50 years of investing in a retirement account. You want to see it 5, 6, 7, 8, 9, 10 times greater than it would have been had you strictly stuck to an index fund. When the model is long, while it's long, the average gain is 26%. The average gain when it's positive is 26%. The average loss when there's a loss in the trade is 1.41%. And we'll see, it sounds ridiculous. Let's continue. We actually know theoretically, if you have a model that goes flat when you sell, you should be able to make money if you go short. So we don't not recommending anyone to go short because it's far more volatility when you go short. But using the same data and using the same dates, had someone started in 1957 and had he bought SP 500 on a buy signal, and rather than invest in T-bills, had he went short the market, he would have gained, rather than 18.5% per annum, he would have gained 22% per annum. So his $10,000 would be worth $8,793,203,930. Okay, $8,793,203,930. There's a P
That is
on the other
crazy.
hand would be up at 11% is up to 13 million, 12, 13 million. So pointing out, I say this because theoretically, as you know, it doesn't make sense. No model that gets you out of stocks and is successful, any model that gets you out of stocks and is successful must also be successful if you go short instead of going to T-bills, or else there's something wrong with the model. That's just normal mathematic theory, and that's what I want to point out. What you would have done if you go short, but we're not recommending you go short based on this model. Now, let's go a little bit further and see this. This is the 5 years. I broke from 1957 to current to 2025 in 5-year increments, so your viewers can get an idea of exactly what the buys and sells look like. So the first buy takes place in early, it's actually in October of 1957. Here's a sell, an 8% market decline, and the market we didn't get any buy signals until right here. You see, I'm going through the 5 years at a time. This is a 95.4% of the long trades are profitable, 18.5% per annum. So this is basically here you got a sell and a buy within days of each other. The market was down some 8, 9, 10%, and we got a buy immediately after the sell. There are 3 instances where you got a sell and a buy in the same day. We don't display that. For example, I'm going to show you which one it is so you'll know. Just for in 2011, right here, 2011, this decline here, you see? This was
Yep.
in 2000. The market was down 7.5% one day. By the close of the next day, it was down 12.5%. It was down 5% on one day, the day of the low. We get a buy signal on the day of the low. Actually, we show it here. It's a buy signal, but no, this is not 2011. Yeah, this is 2011. This is not the right day. It's 2000. I'm sorry. Then we did get a buy signal. That was a great trade. We're talking about in 2015, which is the next chart. I'm sorry. This is it. See, 2000 from here to here, the market was down from 12%, yet we didn't get a
Yep.
sell. Why didn't we get a sell? If we're going to sell every 8%, why did we not get a sell? The reason is because this decline of 12%, we got a buy signal right here. So then the count starts again, the market rallies, and you wait for the next 8%, which is right here. This is a very important thing I'm pointing out. We should have got a sell signal here on August 24th, 2015. The market went from down 7.5% to down 12%, but we didn't get a sell signal because we got a buy signal. And that's why the next sell signal doesn't take place until January of 2016. I want to get that behind us, and let's continue further. But basically, the point of this slide is just to show how this model works in real time, showing you the buys and the sells. And we can go to where we are now. The last buy signal was on April 4th, 2025, one day before the low. So most of the buy signals take place after the low because most of the models do not base itself on oversold based on a rally, often oversold. But when there's very, very major oversold conditions, we can get a rally. We get a buy signal before a low. Another instance of a buy signal before the low was in 2020. The market, we got the buy signal one day before the low. The market was down 7% the next day. But had you bought the day after that 7% decline, your return would have been lower than getting in the day before the low because the market was up more than 7% on that day. So this is basically a picture of how this works. It's just a mechanical. I could have made this up. How do we know it's even true, right? We never know. Plenty of charlatans in this business. Plenty of people who claim to have a model, but they really can't show what's under the hood. We're going to try to show next what's under the hood. First, I want to say the logic. How we've been published in the Journal of Technical Analysis, and this I think I may have had this chart in that report. It goes back about at least 10 or 15 years ago. We look for rarities. We don't look for crossing of moving averages, which happens, often. We don't look at necessarily what the Fed is doing. We look for rarities in the data. For example, this is a histogram of the VIX. It shows the number of days in a row. Okay, the VIX was up 2 days in a row, 11.9% at a time. It was down 2 days in a row, 13.5% at a time. If you look at 5 days decline and 4 days up, I mean, it's more than 60, 70%. We're looking for instances where the VIX is down 9 days in a row, or up 9 days in a row, 0.02%, 0.07%. So point number one is our models are not going to, no one of our models are going to call every top or call every bottom. We've created numerous models that have been built to call 3, 4, 5, 6, 7 bottoms. There've been 55 bottoms since 1957. But we're looking for rarities. We're not looking for generalizations. We're looking for things that only take place at market. Generally, for the model, we're looking for the things that generally only take place at market lows. Let me give you another histogram because this is an actual. The VIX days in a row. It doesn't go into our model. I just show it for illustration purposes. But this is one of our models. We coded it MIL 35 MA BN 35, which is basically on a 5-day basis. You're looking at net up volume versus total New York Stock Exchange volume. Okay. In any index, whether it's New York Stock Exchange or the S&P, some stocks are up and some stocks are down. The stocks that are up have volume, and the stocks that are down have volume. We're looking for extreme volume in the stocks that are declining relative to the stocks that are advancing relative to total volume. So we're looking for periods where the numbers are 55, 60, minus 55%, minus 60, minus 65, or on a thrust off a low. We're looking for these kind of numbers. These numbers in the middle are meaningless to us. So while we can't give an opinion on the market every day. Our opinion, which we started out saying, is individual investors should remain long, not because something is happening today. Should remain long because we got a major buy signal on April 4th, and there's no reason to sell. The market hasn't even corrected 5, 6, or 7%. So most pundits out there are trying to say, oh, something happened today, it's affecting the market. No, what affects the market is what happens at major lows and what happens at major peaks. We had a major low, you had record oversold on April 4th. You had everyone worried about the Trump tariffs, everyone thinking we could head for recession or depression. I mean, great economists were dissing this market, dissing the economy. But we got buy signals. So the reason we're bullish now it has nothing to do with what's happening now. Nothing to do with it at all. We're bullish now because the market gave bullish signals on April 4th and we actually had 80 signals in April alone. We have over 100 signals in April and May, which the institutions get to see, the individual investors don't get to see. But that is why we're still bullish now. Now, why am I started the first slide showing the VXN sell signal. That sell signal may just give us a correction of 10 or 11 or 12%, and it may not even work. I don't know if that signal is going to work, but institutions, we're trying to get better than we do with this model for individual investors. So this is the histogram. Now we're going to try getting into the meat and potatoes, if you're ready for that, unless you have any questions, Adam.
Serve up the steak, buddy.
There you go. This is it. This is it. We said there were 55 buy signals since 1957. I prepared this to show all 55. We're not going to have time to show all 55, but we'll do the best we can. We'll start with the first one, which is right here. October 21st, 57, we got a buy signal. The market gained 85% before the next 15% correction. It gained 55% before the next 7% correction, okay? Great. Now, why did you get this buy signal? What happened? This is the model. Now, I want to point out, Adam, I don't go around telling everybody what's in my model, but here I have an incentive because we're trying to get clients. And we just went public with this retail letter a few days ago. We have over 1,000 clients, so we want to get up to maybe 100,000 clients through this these kind of presentations. So we're going to show a
Okay.
little bit of what we have. We were showing maybe 55 models. As I say, we have 2,000 models. But what happened October 21st, 1957? Well, first of all, the 5-day average of the New York Stock Exchange was the highest in 375 days, sometime in the past 20 days. That means that we're in a regime of high volume, number one. Okay? A regime of high volume makes sense to you? Markets
Yep.
don't always generate highest volume in a year and a half. So we're in a regime of high volume. The S&P 500 made a 60-day new low. The S&P has declined 12% into the low, into today's low. Up volume as a percent of New York Stock Exchange total volume, which I just showed you in the histogram, was at 45%, was at minus 45%. And we have what we call the reverse breath thrust. 5-day advanced declines in the S&P 500 was between 0.35 and 0.39. We call that a reverse breath thrust. Now, it happened right here in 1957. Let's look at the history. It happened, this is the signal. The green means it's part of a model. In other words, it's signaled on this date, and this what we're showing you now is part of that model. It's signal again at 6/26/1962. Again, the model goes long for the same reason, same signal. You notice in this case, the market gained 14% before the next 10% correction, but 79% before the next 12% correction. So this is a great long-term buy signal. Then September 20th, 2001. This is not, we actually got long on September 19th with a different signal. But in this case, the market was up 19% over 73 days in a bear market rally. So not every signal we get is going to lead to a major bull market. But in this case, it led to a 19% gain in 73 days. It happened to have been a rally in a bear market, but it's a very strong rally which we can capitalize on.
Hmm.
Then it signaled on December 24th, 2018, which was I think it was one day after the low. No, it's actually the day of the low. And in this case, the market gained 44% before the next 12% correction. So, and then this signaled on April 8th, 2025. The reason we didn't highlight it in green, because this doesn't go in our model for that date, because we got a buy signal on April 4th through a different model. Now, I'm trying to show this one model in 1957 has given us a signal in 1962 and a signal in 57, but the subsequent signals we didn't act upon because we were already long the market prior to the signal based on other models. So
Got
this,
it.
got it. So this is the first model. Let's go to the next date, November 1st, 1960. Okay, the market had declined 13.85% into its low. And let's see what happened over there. Over here, you had the S&P was down 10%, and it bottomed 5 days ago, never made a lower low. Point number one, we do a day count. S&P corrects down 10%, and it hasn't gone lower for 5 days. Is that a bottom, or is that just it will decline? Let's see the next thing. The S&P was up at least 1% on the day. The S&P 5-day rate of change. In other words, in those 5 days off the low, the S&P had its greatest return in 90 days. New York Stock Exchange was up on the day on increasing volume. Volume was up on the day. And the S&P was down into the low 5 days ago, 7 out of 7 days. Remember we showed the count of days? This has occurred a number of times in the past. It occurred in 11/1/1960, which is a buy signal. July 3rd, 1962. We don't list it as a model signal because we got long earlier than that date. And October 10th, 74, we got long on October 4th, 74. But the point is, like, for example, October 10th, 74, it was early in the bull market. The market never made it another low. And the market gained 54% before its next 15% pullback. And we're going to get to modern times pretty soon, but this is another very important one. June 26, 62. I think that has something to do with the heart attack for Eisenhower. I don't recall exactly what the background fundamentals were, but I think it had something to do with the heart attack for, maybe I'm wrong about it, but I remember something like that. But then it wasn't the Cuban Missile Crisis. No, anyway, it doesn't matter what it was. We don't care about the fundamentals. What we care was the market was down 27.97% into this day, and we got a buy signal. Why did we get a buy signal? Well, again, the 5-day average volume was we were in a regime of high volume because within the last 20 days we saw the highest 5-day volume in a year and a half. The S&P made a new 60-day low. The S&P 500. Whoa, doesn't this sound familiar? This is the signal we had in 1957. So the signal we had in 1957 that got us long also got us long in 1962. And no reason of reviewing it. There's 57, 62, 2001, 2018, just as before, and April 8, 2025. Let's get to, you want to pick a nice bear market that you remember? We might as well do it that way rather than go through every one.
Sure.
Pick one.
Uh, Gosh. How about just the GFC?
Let's go to 2008 market. Let's see what we got. We had a buy signal on August 8th, 2024. excuse me, we had a buy signal on August 17th, 2007. This is the beginning of that bear market. The Russell 2000 peaked in August. The Russell 2000 made a low, down 10%, never made a higher high, although the S&P and the NDX and the Nasdaq made new highs into October. The S&P peaked on October 9th, and the Nasdaq peaked on October 30th. We got a buy signal. Of course, we got a sell signal prior to this buy signal. Market down more than 8%. We got a buy signal on August 17th, 2007. The market was down 9.43%. We got a buy signal. Let's see what happens next. So the market gained some 8.24% to the next top. So it probably was a wash because we held on. We got out when it was down 8%. It was a wash. Let's continue. When did you get a similar signal to the one on August 17, 2007? You got a similar signal on August 9, 2011. The market gained 81% before the next 10% correction. Got a similar signal on August 8, 2024. The market gained 15%. And as you can see, the median gain is 21% over the next year. Then on March 11, 2008, we got another signal within the bear market. The S&P had already been down 18.64%. This is when you had the Bear Stearns crisis. We got a buy signal. And in this instance, again, the market was up 8% in 48 days. It was a wash. We got in and we got out as the market pulled back. This signal, when did this signal on March 11, 2008, when did it take place in the past? It took place many times. It took place right here, 2008. It took place March 10th, 2009, which was the bottom of the bear market in 2009, which is the great financial crisis. It occurred in February 12, 2016. The market gained 54% before the next 7% correction. December 26, 2018. March 24th, 2020. All great times to buy stocks. Now, I didn't review what went into the signal. Let's do that. Very simple signal. Unbelievable, simple signal to give you all these great buy signals. Remember, the bull market bottom, bear market bottom, bear market bottom, bear market. Very simple. I mean, giving away some of the secret sauce here. The S&P 600 small cap stocks generated a four-day high, highest high in 4 days, 1 day after a 2-year low. Very simple. Anyone can understand it. We have 5 instances in history where the small caps were down at a 2-year low, and the following day they were up to a 4-day high. That's all we need for this model. And here we go. Buy signal here. We were flat on this one. Up 69% before the next 10% correction. Up 54% before the next 10% correction. Up 37% before the next 10% correction. And up 95.99% before the next 10% correction. Now, the question you're going to ask is only 5 instances. That's why I started telling you we're looking for rarities. It is very rare for a market ever to make a 4-day high, even after a 4-day low. Very, very rare for a market to make a 4-day new high 1 day after a 2-year low. When that happens, it means there's a sudden reversal of fortune, called a momentum surge, and that has given us 4 or 5 great buy signals, and occurring basically at the end of the bear market. So this is March 10th, 2009. The market was down 56% to the low, and we got the buy signal on March 10th, which is a couple of days after the low, actually 1 day after the low. And then you see it. Then we saw this on August 17th, 2082. On August 17th, 2000, excuse me, I'm back to this. I'm sorry. We just went through the buy signal we had on March 11, 2008, and we got out. And then we said the next signal of the great financial crisis took place on March 10th, 2009. What went into that signal on March 10th? What the signal was very simple. The New York Stock Exchange had 15 times as much upside volume as downside volume. Let me explain what that means. In any index, some stocks are up and some stocks are down. The stocks that are up have volume, and the stocks that are down have volume. If the ratio of the volume on stocks that are up on the day is equal to the volume of stocks that are down on the day, the ratio would be 1 to 1. 15 to 1 means there's 15 times as much volume in the stocks that are up as in the stocks that were down. So number one, you had 15 to 1 upside to downside volume. Number two, the New York Stock Exchange was up on the day and had greater volume than the previous day. And number three is the S&P 500 itself had 70 times more volume in its up stocks than its down stocks. This occurred on March 10th, 2009, a couple of days after the great financial crisis low. And it also took place on August 17th, 1982, right before 58% gain before the next 10% correction. It took place on August 20th, 82. March 10th, 2009, which just highlighted. Took place again on November 28th, 2011. So the same model that worked for 2009 is working for 2011. It signaled again on December 20th, 2011, and December 31st, 2012, with some short-term panic sell. We don't know why. And December 26th, 2018, and here's the advertisement. And our website is www.miltonbergedge.com if anyone's interested in anything more. It also signaled October 4th, 2022. That was a very interesting low because the Russell 2000 actually peaked in June while the Fed was still tightening. And the Russell 2000 exactly bottomed in June, never made a lower low in October. The S&P and the Nasdaq did make low lows in October, slightly below the lows in June. We got this model signals on October 4th, but we didn't highlight it in green because we were ready to long. We got long on September 26th, the day the Russell made its secondary low. We had a buy signal on September 26th. That's what we don't highlight as part of a model. April 9th, 2025, we have many clients, institutional clients, who are very nervous because the S&P was up 9% in the day. They say, oh boy, this is like a bear market rally, because some people believe that the only times the market rally 9% of the day is in the bear market, which is totally untrue. You can see a 9% gain in the bear market or in a bull market. And in this case, the upside downside volume is what told us to go long. So this particular model, just to go how we look at these models, we look at what is the greatest gain over the next 252 days after this model signals. Because this model had many signals. So as you can see, 56%, 51, 59, 22, 18, 29, a median of 30.45% for this particular model. Then, anyway, that was a great financial crisis. I hope I gave you some idea what we're looking at.
Wow. No, look, so it's clear the immense amount of rigor that's gone into this, Milton, and I love the fact that you can look at a pattern that appears, right? Okay, it's a buy signal, but you can then say, well, this is the same sort of buy signal we saw back here and here and here where it worked before. So a couple quick, just sort of practical questions for you on this. So if somebody is trading based off of this,
Yes.
should they just be buying the SPY, buying and selling the SPY?
This is we are recommending getting individual investors. Institutions are totally different. We have many institutional clients that are a totally different picture, but no sector choices. Just get into the SP 500. You have 80% of the stocks in the New York Stock Exchange. Historically, the SP 500 moves up in bull markets. If a capitalist system continues, should continue having bull markets. If we somehow turn into a socialist system, you'll still have markets. But they're probably more volatile. So this model should still work. So yes, these clients, the retail clients, should not try to outsmart the model. The model is built buying the SP 500. That's all you have to do.
Okay. And again, I sort of asked this earlier, but I just want to ask it again for clarity's sake. It is binary, meaning you are
Binary.
all in or you are all out. It's
Not
not
incremental.
like,
And I'm glad you asked that again, because unlike our institutional service, this model acts on the first signal. In other words, we had two signals on April 4th. We had signals on April 8th. On April 9th, maybe had 30 signals. For institutions, I may decide, let's wait a little bit. Let's see how the market acts after you only had two signals. For the retail, the model is built. We're not going to use any judgment. We buy any signal, any first signal we buy. In this case, it was April 4th. And actually, it turned out to be much better than buying after April 9th, because it just turned out much better as far as returns go. So yes, it's binary, and we follow the first signal, and you're 100% long the SP 500 when you're long, and you're 100% long treasury bills when you're out of the market. And this is far, in my opinion, it's certainly less riskier than the 60/40 program, where people are on the market all the time. You get a bond bear market, what do you do? Which we saw. You get a stock bear market, like, what do? You just say, hey, it's 60/40. You have a bond bear market, a stock bear market for the same year, you're really in trouble. This is basically saying you're diversified, which makes a lot of sense. Be diversified, because the SP 500 is diversification. You're going to take advantage of the great bull markets. There are many great bull markets, and we'll get you out of there before a major bear market. And if we got you out early and there was no bear market, our models will get you back in. And if we don't get you back in, the worst that happens to you is you're gaining 3, 4, 5% of your treasury bills until we get the next buy signal. So it's really, really a very simple, easy program. And the main thing for individual investors is they don't have to worry about what the market's doing on a day-to-day basis. We'll notify them when it gets time to get out, and we'll notify them when it's time to get in. Right now, they officially got in April 4th, and they're sitting pretty. If the market's up some 36, 37% since April 4th, you don't have to worry, because if you're worried the market's going to go down 30 or 40%, like some people say, it's the first got to go down 8%. So let's wait till it goes down, or 7%. Let's wait till it's down 7 or 8%, and then we'll reassess, and then we can get out. And instead of gaining 39% off the lows, you gain 30% off the lows. Still a great trade.
What this reminds me of, Milton, is Warren Buffett talks about Ted Williams as the science of hitting, right? Where Ted Williams kind of knew in his entire batter's box which areas he had the best chances of hitting the ball. And Ted Williams would say, basically, my job is to wait until the pitcher pitches a ball right where I want it to be. Now, what Warren Buffett says is the problem with Ted is that um, he could have strikes, so he might have to swing at a ball that's not perfect. Where Warren Buffett said, "I don't have that pressure. I can let 10,000 balls go past me until I see the right one." Your
Mhm.
model basically says, "Hey, we're looking at all the extremes, the real outliers that give us really high confidence that if we swing, it's going to be a good swing." And those don't happen all that often, as you said here. So like you're just waiting for the fattest, most obvious, highest probability win pitch, and you're only swinging when it's in that perfect
Yes,
sweet spot of your batter's box.
exactly. That's just half the story. Remember, waiting for that swing and waiting for that pitch. And once you get that pitch, in other words, imagine if Ted Williams is swinging, he got the right pitch, and for the next 15 seconds before the ball goes to the stands, he's worried. What if it collapses? What if a hurricane? No, once he got off the bat, you already know that it's going to go over the fence. You understand?
Hmm.
Scientifically, this is exactly how this works. Once you get this combination of indicators at a market low, you know the market's going to rally. You don't have to worry about whether it'll rally. You don't have to worry when it starts turning down or when to get out. You don't, and that's really the thing behind it. Wait for the fat pitch, but once you get that pitch, you don't have to worry that maybe the market will decline. If it declines, you get out. But based on probability, the market should go up, as I showed you in various. Now, I want to point something out because I don't want to give a false impression because we have a large institutional client base. We're charging our individual investors $10 a month because I like to get up to 100,000 clients. So making really basically giving away all this research. But I want to point out something very, very important, and that is that institutional investors get far more than the individual investor is going to get. And let me show you what I mean. If we have another couple of minutes, I'm going to show you
Yep.
what we have for the institutions. Because I'm sure there's some institutional investors watching this and say, "Oh, I'm going to sign this for $10 a month." Yes, but you're not going to get what we give our institutions. First of all, institutions we give sectors. We have a long only portfolio, which I will show you in a minute. But let me show you exactly what I want to point out. Each of these dates represents a date that our model signaled. And I want to show you something. So this model was built on 50 indicators, 50 models, not even 50, 45 models. I said we have nearly 2,000 models. Let's just pick it. Let me just show you what happened lately in April, just to give you an idea, okay? See all day, see these hundreds of dates to 1957, all legitimate buy signal dates. I'm going to show you what happened in April. See the April 4th? We clicked on April 4th and we got this chart. It's a signal, okay?
Hmm.
I'm going to click on April 7th and we have just, yeah, we have two signals on April 7th. I'll click them both. You see, two signals on April 7th. It's unfortunate I can't screen the screen. Oh, I could, yeah, it doesn't work. You screen on April 9th, just to let you know, I'm going to open up all the signals for April 9th. You can see them as they open up. These are all signals. We have about 30 signals
Okay.
on April 9th, you see?
Yep. I see them popping in. Yep.
See that? The model was built using only one signal for each market bottom. For institutions, we have signals at the bottom, we have confirming signals, all taking place within roughly 10 days of a low, before a low or after a low. We have signals and more signals and confirming signals. And that's, basically we're holding hands for the institutions. But for the retail client, all they're going to get is that one buy signal. You hold on, hold the S&P till you get a sell signal. I mean, this is very robust data. We did a very, very serious work for this. But as I say, we share most of our research with the institutions. We decided this year to start sharing with the retail accounts or the individual investor accounts, and that's why we created these models. But I'm just opening more and more just the signal April 4th. Each signal is different than the prior one, you see, just to show what we have. If I could spread sheet a little differently, it'd be a little better, you see. You go to a place like the most signals we ever got on any days was at the low in 1982. Starting on August 10th, 11th, 12th, 17th, 18th, 1982. That's when the great bull market began. And then we have probably, I'd say over 200, 250 signals during that period. So basically, I hope I've done a good job and tried to explain what we've been doing.
All right, Milton. Well, look, let me get to the most important question then. So, for people who are, the light bulb's gone off, they've said, okay, Milton's built this amazing model. Institutions have benefited from this in the past, but now he's got a retail version of this. And honestly, it is an incredibly easy one for me to follow because I basically just sign up for $10 a month. And I kind of just go about my life. And then every couple quarters, every year or so.
We write a report twice a month.
Okay,
Just
you write a report
clients,
twice a month.
right? And if we get a buy signal or sell signal within the week, we immediately will notify the clients, along with our institutional clients, but we'll be getting the data anyway.
Yeah. So as a client, I'll get, but the key thing is I can read your monthly reports as they come out. But from a trading perspective, I just go about my life until I get an alert that says, hey, we just triggered a buy signal or a sell signal.
Okay.
And that doesn't happen very often, as your chart showed, right? Maybe 2-3 times a year, maybe none at all in a year.
No, on average, one trade over a year and a quarter on average.
One trade over a year and a quarter. Okay, so it's again very easy. You can go live your life and then just trade when the model says to. So $10 a month. I think you put the URL up earlier, but I just want to make sure folks know clearly where to go if they're interested. What URL should they go to?
It should be www.miltonbergedge.com, I believe is what it is. miltonbergedge.com.
And Milton, when I edit this, I'll put the URL up on the screen so folks know where to go. Folks, the URL will be in the description below this video as well, so you can get there with one click. Milton, obviously, a lifetime of work has gone into this model. Congratulations on putting it together and making it available to the average investor here. Thank you so much for coming on and walking us through it. I know it's new in the sense that, yes, you backdated it back to the late 50s, but the model itself has only been live for less than a year. But really looking forward to seeing how the future performance goes, and hopefully it should go just as the backdated performance has gone.
It should go, yeah, exactly. Thank you so
All
much.
right. All right, Milton. Cannot thank you enough, my friend. Look forward to having you back on later on in the year. Folks, please let Milton know how much you appreciate him walking us through all this by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Thanks so much for coming on, Milton. Again, best of luck with this new model and look forward to talking to you later in the year.
Thank you. Bye-bye.
All right. Everybody else, thanks so much for watching.
The price has been going up, but it's been driven by the East, by Asia. It's not the U.S. and Europe and Australia and so on. It's not the West doing this. It's the East that's been causing the $1,000, the 48% price increase in gold this year so far in just 9 months. It's when the U.S. does come rushing in, and they will. Then we're going to see some real fireworks. But it's better to buy gold at $400, $500, $600, $700 an ounce than at $3,600 an ounce. But it's not too late. $3,600 is going to look like a great price. You're going to look brilliant in the future when it's 5,000 with some other digit in front of that 5,000.
Asia, not the West, has been the primary driver of gold's latest climb, which has fueled a 48% increase this year. Asia is currently leading the rebound, but it might take off when investors from the US and Europe join in. Goldman Sachs has warned that gold may increase to $5,000 if the Fed's independence is undermined. Such forecasts are perceived as reliant on robust investor flows, which erodes trust in conventional safe havens such as the dollar and Treasury securities. Mike Maloney, a precious metal expert, argues that $5,000 gold is far too low, especially if Trump undermines the Federal. Big names like John Paulson, J.P. Morgan, and Goldman Sachs now call for $5,000, but critics say that figure ignores today's massive debt and weaker dollar. Gold is up about 40% this year, with expected continued gains driven by the weaker U.S. dollar, Fed rate cuts, geopolitical risks, and increased demand from central banks and ETFs. A correction of 5 to 6% is possible, but many expect gold to top $5,000 per ounce in 2026. Historically, even a small wave of investors piling into gold can trigger a rush from stocks and real estate, sending prices soaring well past $5,000. For now, analysts note that Western institutions are beginning to increase exposure to gold via ETFs and other channels, which could trigger strong upward momentum once that catch-up demand intensifies. As we dive into the video, Don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think actually it's if Trump undermines the Fed, with gold, 5,000 is a ridiculously low price. It's just stupid, idiotic low. You have to put a 1, a 2, maybe even another 5 in front of that 5,000. But the very fact that they are saying this, and John Paulson just said $5,000 an ounce, and JP Morgan just said $5,000 an ounce, and people are reading it. So Goldman Sachs is finally woken up. I was saying, my analysis in my first book, I had 3 different ways of looking at it, and I came up with a range of the low 6,000s to the mid 6,000s. But that was back then when the debt was so small, and when the dollar was, in a much better position. But the main thing here is that Goldman Sachs is writing positive stuff about gold. They were so negative on gold when gold was $700 an ounce, $400 an ounce. That's when, no, you don't want any gold. You want what we sell. Now, gold has proven them so wrong. All these people, JP Morgan, Goldman Sachs, they are so incredibly wrong year after year after year. And now they're jumping on the bandwagon here because they're looking like idiots. But the fact that they are saying this, even if Trump does nothing, could cause gold to go to $5,000 an ounce. If Trump does something that undermines the Fed, $5,000 an ounce is an absolutely idiotic prediction. It is absurdly low. First of all, if anybody that bought the Great Gold and Silver Rush of the 21st century, and they've read the chapter on Giffen goods and about the panic that happened back in 1979, first month of 1980, and then the differences between the bull market of the 70s and today, if 1% start going toward gold and it goes toward $5,000 an ounce quickly, then 2% are going to go, 3%. And then there's going to be a rush of a whole bunch of other people where it's not treasuries that they're selling, it's other things that they're selling. It'll be stocks and real estate, and everybody starts to gravitate toward the thing that's going up fastest, toward the thing that is the ultimate safe haven investment, especially in turbulent times, war, all of this stuff, when the public comes rushing in, and they're not right now. The price has been going up, but it's been driven by the East, by Asia. It's not the U.S. and Europe and Australia and so on. It's not the West doing this. It's the East that's been causing the $1,000, the 48% price increase in gold this year so far in just 9 months. It's when the U.S. does come rushing in, and they will, then we're going to see some real fireworks. But right now, Asia has lit the fuse, and this is part of lighting the fuse. Goldman Sachs writing this stuff, JP Morgan writing this stuff, and big successful investors like Paulson writing this stuff. Now that it's getting out into common public knowledge, I want to, again, my predictions on this were 17 years ago. And it's better to buy gold at $400, $500, $600, $700 an ounce than at $3,600 an ounce. But it's not too late. $3,600 is going to look like a great price. You're going to look brilliant in the future when it's 5,000 with some other digit in front of that 5,000.
Mike points out that while Asia is driving today's gold rally, the rise might become explosive if the United States and other Western countries join in. Gold's rise is driven by forecasts of U.S. rate cuts and declining real interest rates, which make it more appealing as the currency depreciates. Demand for safe havens is increased by the OECD's warnings about stagflation dangers and negative real rates. The surge is being driven by Asia, but Western investors are starting to follow suit, which might increase gains even more. However, after Nixon terminated Bretton Woods, gold first increased under positive rates in the 1970s. However, the real boom was powered by negative rates once Americans and Australians were permitted to purchase. According to Mike, the official CPI may be understating inflation in comparison to today. The use of shadow statistics from pre-1980 techniques indicates that we are already in negative real rate territory. These circumstances could work as gold's rocket fuel, indicating substantially greater prices to come, especially with rate reduction on the horizon.
And we're already going north because of Asia. And if we start buying, Asia is good. Now, I want to remind everybody, if they really need, a lot of people viewing this have read The Great Gold and Silver Rush of the 21st Century. But in the first bull market in the 70s, it was a very small percentage of the world's population. It was like 5% for the first half of the 70s. And then from 75 to 80, it was about 10% of the world's population. This time, it's that same percentage plus all of it. I mean, it's everybody except North Korea participating this time. And so it's complete. When people say, oh, this time it's different, with gold and silver, it's the only time that statement is true. This time it is different, really different. Oh, you'd have gold price, rates, and the CPI to create the negative real rates. So you've already got three, but add one more column of the shadow government statistics, alternate CPI, which I keep on reminding people, it's not like conspiracy theory stuff. It is government numbers. It's the CPI as used from World War II to 1982. So it's just the way the government used to measure consumer price index, and make, you've got red. It would be good to add some more stuff. So you need colors, but remember, people that are color challenged, it's red, green. So you don't want to use both those colors on the same chart. But I want to point out the first half of the 70s bull market, we were in positive rates, but that portion of the gold rising was from the date that Nixon took us off of the Bretton Woods system, but it was still illegal for Americans to buy gold. It was only Western Europe and Canada participating. Australians couldn't buy. American citizens couldn't buy. There were no markets in the USSR, so everything inside the Iron Curtain, all those countries, China under Mao, they could not participate at all. And so that was the only area during these red boxes that you've pointed out where it's predominantly negative interest rates. Once the US joined the party and Australia joined the party in the 70s, which happened the first day of 1975, we were in this negative real rate territory, and we stayed there until gold peaked. And the second that they cut rates, we are in that negative real rate territory. It doesn't show us being in it right now, but we probably really are. I would love to see this with shadow government statistics, alternate CPI. And we might want to do a column that averages the two, because I do think the truth lies somewhere in the middle of the old government numbers, the original CPI, and the new CP lie. And so it'd be neat to have our own inflation indicator, the goldsilver.com inflation indicator that's just averaging the two, previous government numbers, new government numbers.
Could gold prices swiftly rise beyond $5,000 and reach far higher levels if Western institutions greatly increase their exposure to the metal? Is this gold cycle essentially more robust than the boom of the 1970s given the current low real rates and high debt levels? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
In the next handful of months between now and the end of the year, silver is likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher price of gold. Well, right now, silver's 1.12%. Decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds. 100 to 200 would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices, while COMEX and LB delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really relevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divided an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, These levels go back several years, by the way. You're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, "Oh boy, you break through that, and I'm gonna blow the cork off this thing." The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? You know, do you remember the movie The Big Short?
Yeah.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals, okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. The annual production of silver is not increasing. It's plateaued and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it, okay? And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. you suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up, because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
In 2025, Arcadia Economics' Chris Marcus notes the silver market faces structural shifts amid rising deficits. Silver has surged 88% since early 2024, climbing above $40 for only the third time in history, according to a report by Arcadia Economics. Industrial demand reached a record 680.5 million ounces in 2024, while retail selling and supply constraints highlight growing imbalances. Institutional flows, new technologies such as Samsung's silver-heavy batteries, and fresh central bank interest in Russia, coming from Russia, Saudi Arabia, and the U.S. I wouldn't say that we're central bank buying yet, but central authorities are buying silver now. We're going to be hoarding silver now. They all suggest silver's strategic role is expanding rapidly.
As deficits widen, significant structural shifts in the silver market have been noted. Silver has risen 88% since the beginning of 2024 and is now above $40 for just the third time. In 2024, industrial utilization reached a record 680.5 million ounces, propelled by innovations such as Samsung's silver-rich batteries. Although there are obvious mismatches in retail sales and supply, institutional inflows and escalating interest from Russian, Saudi, and American authorities indicate that silver's strategic significance is rapidly increasing. Vince Lancy, a veteran trader, metals analyst, and founder of Echo Bay Partners, highlights an extensive analysis of silver's prospects for 2025 published by Chris Marcus of Arcadia Economics, highlighting the metal's significance for years to come. Samsung's silver-heavy batteries are a major emphasis. The estimated demand for silver is so high that a logarithmic chart is needed to explain it. Marcus's enthusiasm and thorough analysis are evident in the report, which is a great tool for anyone interested in silver. The focus is now on Trump's new Executive Order 232, which raises concerns about the future of policy because it noticeably ignored silver despite previous references. Powell has essentially deprioritized rigorous inflation targeting, so rate cuts are more dependent on job losses than inflation, even though upcoming data like the CPI and PPI may influence markets. As we begin the video, don't forget to hit the bell button and subscribe so you don't miss any updates. Please leave a comment below and give us a thumbs up if you found the article interesting. We appreciate your feedback.
Silver's future looks very bright, as well as the unlock post, which is linked in there for Chris Marcus's Arcadia Economics. So, personal professional comment now. Chris Marcus published a mammoth, ambitious report this weekend on silver's outlook for the rest of 2025. While the report covers that time frame, makes it like a timepiece, its implications extend far beyond that, making this a must-read for anyone who wants to understand the likely path of silver ahead. One section worth highlighting is on the Samsung batteries. Now, we had read this and we know about this, but we had never looked at the side by side how much silver was used, how much silver could be used. We even tried to create a graphic for it, but couldn't make it fit. That's how earth-shatteringly large silver's role would be in these new batteries. We put the graphic in. The first graphic was, this is how much silver is used versus this is how much silver will be used. And it was ridiculous. So I had to make a log normal chart. And even then, it's ridiculous. Anyway, Chris was kind enough in the credits to thank me for my contributions. And I'm glad to have played even a small role in what is clearly a labor of love. If you know Chris, you know his passion for silver, combine that passion with detailed industrial analysis, and the result is pretty impressive. The full report is included in the post, and we would recommend you visit Arcadia to take a look at that as well. Moving on. Related post, HeartNet, we mentioned that. Sunday CFTC analysis, that was a really good one. It was a fun one for me too. I got 2 hours of that recorded, and very lively interaction, as well as some good questions. And plus the guys got me to talk more about my childhood trading. Mini pod, macro discretionary, Goldman, gold price near 5,000 and Fed damage. It's starting to look more realistic to me than it sounds. Coming soon tomorrow, probably, we're going to have a breakdown and analysis of Trump's executive order 232 signed this weekend. We have a couple calls into people that we're trying to get some more information back on. We understand the implications for gold. People have been talking about it. We actually have some analysis from a Goldman trading desk, institutional stuff, that'll break down the gold for us. We're going to look at that a little bit closer today. And what we're focusing on now is getting data on what was not said about silver. Silver was not mentioned. And you could say, oh, well, it's just, who cares, right? No, silver was mentioned when 232 was first discussed, but it wasn't mentioned in the signing of the executive order. So what does that tell you? I don't know. We're going to find out. Data on deck, CPI and PPI. Now, those are important numbers. They're always important numbers, and they're going to move the market. But I'm telling you, they're not important unless they're incredibly high for Powell's decision to cut. Okay? The decision to cut is based on the economics. Are we firing people or not? Not the inflation. He has already raised the inflation target by abandoning the FAIT. He has basically said, I can't focus on inflation anymore. He blamed it on the FAIT, tied it to the goat, released it into the desert. The scapegoat is out there. It's done.
Vince Lancy clarifies that unless inflation is exceptionally high, Powell's rate cut plans are unaffected by short-term movements in gold based on CPI or PPI data. Intraday charts and stringent risk management, setting tight stops, taking partial profits, and letting the remainder run if momentum holds, are their main tools for trading. At the moment, silver provides little clarity but may be creating a bull flag, while gold appears bullish above critical levels. Instead of chasing moves, the emphasis is on risk management and discipline. Let's dive into the interview.
Because look, if you see gold drop $100 on CPI or PPI, check in. Why? It's not going to change his plans unless it's ridiculously high. All right, let's move to the markets. As I said, you don't want to buy gold now because of this symbol. If you're buying gold, you're buying it for a completely different reason. Okay? And I'll tell you what the reason is for me. The reason is I'll take this analysis, this system that I use, and I'll break it into an hourly chart. And I'll say my bias is bullish because of this chart. And then I'll put it into an hourly chart and I'll look for an entry point that tells me acceleration is due. That's the weekly in gold, weekly in silver. Weekly in silver's marching along. The daily in silver really was the cue there. Let me go to a couple other systems. Okay, so I'm doing my intraday analysis right now, right here for you. There's an algo buying the market. It's not safe to buy it below 36.13 for the next 2 hours. So I'm long. I'm not buying it right now, but I'm long right here, and I'll sell it on a stop loss below 36.13. And how much am I risking? $5. I'll sell it at 36.28. That's it. Risk 5 to make 10. Go with the flow. Stop yourself out and move on. Now, if the market gets down here and breaks this, I back off. I reset. As long as it's above these lines, that's poly market, by the way. Poly trends, not poly market. Poly market's the gambling site. I think these lines are pretty important for the day. And even if they weren't here, I'll take it out so you can see it a little bit more visually. This is a line going. This is a typical line that I would draw. I was like, all right, this is where it paused. This is where it got rejected. This is where it broke through. As long as it holds in this area here, 35.98 area, then I would look for another reason to get long. If it breaks 35.98, I start looking for reasons to get short. Intraday, okay? So if this never breaks, so I just bought it right here, right? In our hypothetical, I bought it right here. And I don't get stopped at, and it goes to 35.28. Should I take my profit to 36.28? Well, yes, I risked 1 to make 2, right? No, I'm not going to do that today because I'm already very bias bullish. I'll sell half. I'll let the half run for the rest of the day, for the rest of the week, for the rest of the month if I have to. And that's the idea. You get a good entry, you put a tight stop in, and you trail your stop higher. That's the way to look at it. Let's see what silver offers. It's not rocket science. It's just being disciplined with your risk. Silver offers me no insight right now. No insight, at least on these things that I look at. Let's see what Poly has. I'm doing this for the chat, guys. I know you guys are looking at this very much. All right, so Poly gives us a level to not be bullish above for the rest of the day. 41.18, which is pretty close. So no Bollinger Band analysis here. You ready? You buy it here with 41.18 as your stop. If it goes below 41.18, you're neutral. If it goes below 40.91, you're bearish. The rest of the day, intraday stuff. This doesn't affect my silver physical. Doesn't affect anything. I'm just trading. How's the movie go? It's just money, right? And silver's not just money. Silver daily, that's great. All right, so this is shaping up like I can't believe I'm saying this. This is shaping up like a bull flag.
Silver's role as a strategic asset is rapidly expanding, supported by record industrial demand, new technologies, and growing institutional interest, even as policy signals remain uncertain. Gold continues to show strength, while silver may be setting up for its next move. For investors, the key lies not in chasing short-term swings but in understanding the bigger structural shifts and managing risk with discipline. How might Trump's Executive Order 232 affect silver's future role if it continues to be excluded from policy discussions? Could Samsung's silver-heavy battery technology accelerate silver shortages faster than markets expect? We would love to hear your opinions, so please leave a comment below. Please remember to subscribe for more material, and give this video a thumbs up if you found it helpful. We appreciate you joining us on this adventure.